Jerome Powell just cut interest rates. In response, the market, according to the CME's own FedWatch tool, immediately priced in an over 80% probability of 2 more cuts before the end of the year. Here's the problem. In his press conference, Powell essentially told everyone not to expect that. This is a direct standoff between the Federal Reserve and the market. One of them is about to be proven very, very wrong. Look, if you're short on time, or you just don't want to listen to some random guy with a keyboard and a cat who frankly seems to judge my decision, here's the one thing you need to know. The rate cut itself is a tailwind for stock valuations. It makes the math look better. But the reason for the cut, a weakening economy, is a massive headwind for company earnings. The entire market's direction for the next few months will depend on which of those two forces wins out. For those of you who are new to the channel, my name is DataCat. I spent a good number of years working as an analyst inside one of those big Fortune 50 companies. My job was pretty much to stare at data until it made sense. Spoiler alert, most of them never did. I traded that life for this one because I think you deserve the same kind of deep dive analysis, just without the corporate buzzwords and, the soul-crushing meetings. So, let's get into what actually happened. The Fed's decision to cut the federal funds rate by 25 basis points was, on the surface, exactly what the market ordered. But when you listen closely to what Jerome Powell actually said, you'd get a very different picture. He delivered what I'd call a reluctantly dovish pivot with hawkish forward guidance. That's a mouthful, I know. But what it means is, they gave the market the candy it was screaming for, but they wrapped it in a message that said, don't you dare ask for more unless things get really bad. So what drove this? The number one reason was a major shift in how they see the job market. For what feels like an eternity, the Fed has been like a cat, singularly focused on a laser pointer dot on the wall. That dot was inflation. But yesterday, they finally acknowledged the mouse scurrying in the corner of the room, the risk to the employment side of their job. Powell himself said the balance of risks has shifted. He pointed out that while unemployment is still low, it started to edge up. Job gains have slowed down. He even used the phrase risk management cut, which is Fed speak for an insurance cut. They're trying to get ahead of a potential problem. He described the current environment as low firing, low hiring. And the big worry there is that if companies do start laying people off, there aren't a lot of new jobs for those people to go to. That's how unemployment can spike and spike quickly. But and this is the part that Wall Street might gloss over, the message about the future was incredibly cautious. Powell went out of his way, not just once but repeatedly, to say that policy is not on a preset course. He basically told us they're in a meeting-by-meeting situation. Translation: they have no idea what they're going to do next, and anyone who tells you they do is just guessing. What's more, the committee is deeply divided. The report they released, the summary of economic projections, showed a huge split. 10 members see 2 or more cuts this year, but 9 of them see fewer than that. It's almost a 50-50 split. This isn't a unified group confidently marching forward. It's a committee full of people with very different opinions, which tells you just how uncertain the path forward really is. They also shut down any talk of a bigger 50 basis point cut. That signals they plan to move slowly and carefully, if they move at all. So what does this all mean for the stock market? Well, the narrative has officially changed. We're no longer in a market defined by fighting inflation. We are finally now in a market defined by avoiding recession. Oh, and let's just forget to acknowledge the potential fact that this might be too late by now. This creates a massive tug-of-war between two opposing forces. On one hand, you have a tailwind. A lower policy rate reduces something called the discount rate, which is a fancy term for the number analysts use to figure out what a company's future earnings are worth today. A lower number there provides a mathematical lift to stock prices. It's a positive. But on the other hand, you have a serious headwind. The entire reason for the rate cut is a slowing economy. That means slower sales, shrinking profit margins, and customers who are thinking twice before they spend. That's a direct hit to corporate earnings. The market is now like a cat that's been offered a delicious treat, which is the lower rates But at the exact same moment, someone turned on the vacuum cleaner in the next room, which is the slowing economy. Its next move is, let's just say, uncertain. And this new environment is not going to treat all stocks the same, especially in the tech sector. We need to break it down. First, you have what we call long-duration growth tech. Think software as a service companies, non-profitable tech, cloud computing. I will not name them all out in this video, but you should already know who they are by now. Their stock prices are almost entirely based on the promise of earnings way out in the future. These companies are the biggest beneficiaries of that lower discount rate tailwind. For them, the math boost might be powerful enough to outweigh worries about the economy for a while. Second, you have the mega cap, profitable tech giants, your Apples, your Microsofts. These companies are caught right in the middle of that tug of war. They get a nice little lift from lower rates, sure, but they are also completely exposed to the global economy. Their profits depend on advertising budgets, people buying new gadgets, and companies investing in new technology. Their performance is going to be a real-time indicator of whether the market believes in a soft landing or not. And finally, you have the wild card, semiconductors and AI infrastructure. Think Nvidia and all the companies that support it. This group has its own powerful story going on, and Powell actually gave it a quiet nod of approval in his press conference. He mentioned that a key driver of economic activity right now is, and I'm quoting, the AI build-out and, business investment. This suggests the Fed sees AI as a unique trend, something so strong it might just power through a cyclical slowdown. This could make the AI space a sort of safe harbor for investors who still want growth even in a shaky economy. So the Fed's focus has clearly shifted to the labor market. Any data on jobs is now the most important thing to watch going forward. The market will become hypersensitive to this piece of data. Bad economic news, especially on the jobs front, will become good news for the market, as it increases the odds of more rate cuts. Good economic news could lead to sell-offs if it's perceived as tying the Fed's hands. Expect increased volatility around data releases. Alright, so that's the fundamental story. It's a tug of war between a helpful rate cut and a worrying economic outlook. But as I've always said, that's only half the picture. Let's look at what the price action itself is telling us, because the chart for the SPY is painting a very clear picture of a market that's about to make a big move. If you look at the chart from Monday through Wednesday, leading up to the announcement, you'd see the technical footprint of a market that is holding its breath, coiling up like a spring. We see this in a few ways. First, the market structure is just sideways. It's not really going up or down. It's trapped in what traders call a rectangle or a wedge pattern, where the trading range is getting tighter and tighter. This is a classic sign of a battle between buyers and sellers where neither side has won yet. We also see a squeeze pattern, which just means that volatility has dried up. And that condition almost always comes right before a big expansion in volatility, a big move. This consolidation is the direct result of the uncertainty we just talked about. The market is pinned between a key support level at $656.90 and a major resistance level at $661.78. Traders are just not willing to commit to a direction until they fully process the Fed's message. But inside this coiled spring, there's a fascinating conflict happening. On a short-term intraday basis, things actually look bullish. The price has been staying above the VWAP, which at $658.80 is basically the average price paid for the day. Holding above it means the average participant is in profit, which provides a floor. We're also seeing an increasing volume trend. This isn't quiet, sleepy trading. This is big players actively building their positions for whatever comes next. However, when you look at the bigger picture, you see a more bearish structure. The market has tried to break above that $661.78 resistance level twice, and it has failed both times. This is a classic double top pattern. It's the chart's way of showing us the market's fear of that hawkish forward guidance. On top of that, the momentum divergence signals that on the second attempt to break that high, the buying power was weaker than it was on the first attempt. The conviction was fading. This conflict on the chart perfectly mirrors the fundamental story. The market wants to rally on the rate cut. That's the bullish intraday picture. But it's being held back by the fear that the slowing economy will limit future cuts. That's the bearish double top. And there's one more thing that's about to pour gasoline on this fire. Friday is a triple witching day. It's a quarterly event where stock options, index futures, and index options all expire on the same day. All you really need to know is that it forces a massive amount of trading volume, and it can act as a powerful accelerant for whatever direction the market is already heading. The Fed decision is the catalyst. Triple witching will be the amplification. So this brings us to two very clear actionable scenarios. First is the bullish breakout scenario. If the market decides to focus on the good news, the rate cut, and ignore the cautious warnings, the signal will be a sustained break above that double top resistance at $661.78. A move above that level, especially on high volume, would signal the bulls are in control and could trigger a very sharp rally into Friday. Second is the bearish breakdown scenario. If the market gets fixated on the bad news, the slowing economy, and the Fed's reluctance, the signal will be a break below that key support level of $656.90. This would confirm the weakness we saw at the highs and could trigger a rapid decline as all that coiled energy is released to the downside. Those two levels are now the most important lines in the sand for the market. The waiting game is over, and a powerful move is imminent. Well, that's all for today. If you want to see how this plays out and get more no-nonsense analysis like this, please consider hitting that subscribe button and maybe the like button if you found this helpful. It tells the algorithm that you appreciate the data-driven approach. Alright, DataCat out. Stay safe and stay sharp out there.